Hello and welcome. Today we are going to present to you our financial analysis for Delta Airlines and United Airlines. The airline industry experienced really dire times during the pandemic, but made a remarkable recovery with the demand from travelers itching to get outside after being inside for so long. My partner Christopher Monk and I, Kayulani Lujan, will be your hosts for this video. Let's get started.
This project aimed to analyze and compare Delta and United Airlines from 2020 to 2023, focusing on their financial performances, managerial decisions, and ethical considerations. The scope encompassed financial reporting, managerial decisions in supply chain, risk management, equity management, as well as ethical issues related to earnings management. We designed our research to include data collection from financial statements, managerial accounting case studies, performance measurements using key performance indicators, and SWOT analysis. This comprehensive approach provided a thorough comparison of two major airline players in the industry, examining their strengths, weaknesses, opportunities, and threats in the context of the evolving aviation market. Our project used these methods to review how each airline has navigated the challenges of the past few years, including the impact of the COVID-19 pandemic and their strategies for future growth and long-term sustainability.
The airline industry in 2024 showed signs of recovery and growth, with Delta Air Lines and United Airlines emerging as key players. Delta ranked as number 21 overall worldwide and number 1 as the most reliable airline in America, while United held the 42nd position worldwide and third for reliability in America. As capital-intensive industry, airlines typically have low quick ratios, indicating the need for very large investments for their aircraft carriers and service systems. The industry asset reliance is reflected in its return on assets, or ROA, which has been improving as travel demand recovers post-pandemic. Airlines are still in a risky financial position, which we can see by looking at how much debt they have compared to their overall value, as we see in the debt to capitalization ratio. This situation is made worse by a few key factors. One being airlines make most of their money during certain seasons, like summer vacation time or winter vacation time. Second being when the global economy isn't doing well, fewer people travel, which hurts airlines. And third, running an airline is very expensive and costs keep going up, such as inflated rates for fuel costs. So when tough times hit, airlines can struggle to pay their debts and stay afloat because they don't have as much financial cushion as other industries might. So our study shows how these figures underscore the sector's resilience and potential for growth, even as it navigates complex financial landscapes and strives for long-term sustainability. In the next few slides, we're going to show you a comparison chart of different ratios for both companies. In the tables, the company with a better performance in a ratio category is highlighted in bold font for their respective year. Industry benchmarks are represented as an average from the years 2020 to 2023. And currency is in US dollars and financials are presented in the thousands. We're going to start off by looking at the profitability ratios. When looking at these ratios, we can see that Delta Airlines has shown a strong recovery in profitability. They improved its net profit margin from negative 72.4% in 2020 to 7.9% in 2023, surpassing the industry benchmark of 7.0%. United Airlines also improved, moving from negative 46.0% to 4.9% during the same period, but it lagged behind Delta in efficiency and profitability. This highlights Delta's stronger ability to convert revenue into profit, reflecting effective cost management and operational strategies post-pandemic. United's slower progress indicated a need to address inefficiencies to remain competitive, but both airlines demonstrate impressive ROE ratios, significantly outperforming the airline industry of 10.1%. It is important, however, to note that both companies use substantial debt to boost returns, with Delta having a debt-to-equity ratio of 5.63 and United at 2.69 in 2023. We're going to see those ratios a little bit later. Now we're going to look at the activity ratios. Activity ratios reveal how well a company manages its assets. In 2023, Delta slightly outperformed United with ratios of 0.80 versus 0.78, showcasing better asset utilization. United, however, showed significant improvement, climbing from 0.66 in 2022 to 0.78. Indicating progress in optimizing its operations. Delta demonstrated better inventory turnover and shorter cash conversion cycle, which suggests better operational efficiency. On the other hand, United performed better in working capital turnover, which measures how effectively short-term assets are used to generate revenue. And these metrics show that while Delta excels in some areas, United finds its strengths elsewhere.
Thank you, Kylie, for taking us through the first part of the financial analysis. Now I'll be taking it over and moving into the liquidity and leverage portion. So liquidity ratios are critical for understanding short-term financial health. United consistently outperformed Delta in both current and quick ratios, signaling stronger short-term stability. The financial leverage is highlighted here due to how turbulent these past 4 years were in the recovery from the pandemic. And when we examine this financial leverage, Delta and United both showcase two different strategies. So Delta's debt-to-equity ratio of 5.63 highlights its reliance on their debt to drive their growth and scale their operations. This amplifies their profitability in favorable market conditions, but increases their financial risk during downturns. And on the other hand, United's more conservative ratio of 2.69 reflects a focus on financial stability, which ensures the company is better to equip economic uncertainties or downturns. These strategies highlight the critical balance that companies must take in order to balance their debt leverage to drive their growth and mitigate their risk to secure long-term sustainability. As we move on to the DuPont analysis, it offers further perspective on the factors that drive return on equity, which breaks it down into profitability, asset turnover, and financial leverage. If we take a look at 2023, Delta achieved a remarkable return on equity of 52.1%, which is driven primarily by their strong profit margin of 7.9%. This efficient asset utilization with an asset turnover ratio of 79.6%. However, a significant portion of their performance is attributed to Delta's reliance on financial leverage, which is again reflected in its high debt-to-equity ratio of 5.63. Now, while this aggressive use of debt amplifies favorable market conditions for them, it also exposes their company to greater financial risk. And in contrast, United, taking a more conservative approach, is supported by their profit margin of 4.9% and their asset turnover ratio of 77.6%. Now, United's lower debt-to-equity ratio of 2.69 reinforces their strategic focus on sustainability. This is, again, limiting their exposure to their risks and staying consistent during economic uncertainties. Delta, they try to prioritize maximizing their shareholder trust through efficiency and leverage, and United taking the long-term sustainability approach. Moving on into the ethical analysis, and in particular, earnings management. Both of the airlines face ethical challenges, particularly in this field or realm. Um, Deregulation has provided financial flexibility, but it also has presented opportunities for manipulation or unethical practices. While short-term gains may result, misleading financial reports damages the trust among investors, customers, and regulators. Ethical missteps and wrongdoing can lead to legal consequences, market value loss, and long-term credibility damage. As we move into the SWOT analysis, in a SWOT analysis, Delta shines with their operational efficiency and disciplined capacity management. However, they do struggle with high debt exposure. United's strengths lie in their financial stability and maintenance service expansion opportunities through high operating costs, though, remain a challenge. Both airlines face threats like fluctuating fuel costs and intense competition, which requires strategic planning and maneuvering to overcome. To address these challenges, though, we propose several strategies. First would be to establish an independent ethics committee to oversee financial practices. Next would be to implement automated auditing systems to detect discrepancies. Third, we would conduct regular third-party audits for transparency. And lastly, but not least, we would shift the focus from short-term gains to long-term sustainability, which is going to include debt refinancing for Delta and strategic asset utilization for United. Overall, though, Delta's financial strength lies in profitability and operational efficiency, while United lies in their liquidity and their strategic diversification. However, both of these airlines must address their ethical concerns and prioritize this long-term sustainability approach. By aligning their strategies with these ethical practices and stakeholder trust, they can achieve enduring success in a competitive market. Thank you for tuning into our presentation, and we thank you for listening.
Thank you very much. We hope to hear from you soon. Yeah, we did it!